Hello, and welcome to another episode of our Stock Pick series. In today's series, we will talk about the business of Alibaba Group, which used to be a Wall Street darling that fell from grace. Why is Alibaba no longer a promising stock among investors? Do we still find the stock attractive at current prices? Smart money chases obvious targets. Traditional stalwarts like Apple and Microsoft command constant attention, leaving extraordinary opportunities hidden in plain sight. Alibaba stands as perhaps the market's most compelling yet overlooked value play. Market wisdom often fails to capture the full picture. Conventional metrics and index movements dominate investment conversations, creating a myopic view that misses transformative opportunities. The disconnect between Alibaba's fundamental strength and current market valuation tells a fascinating story of mispriced potential. Seasoned investors recognize that exceptional returns demand looking beyond the obvious. This analysis cuts through the market noise to reveal why Alibaba deserves a serious consideration. We dissect the company's robust business model, examine its overlooked value drivers, and demonstrate why portfolio managers fixated solely on traditional Dow Jones components risk missing a rare opportunity for strategic diversification. Therefore, is Alibaba purely a value trap or genuine undervaluation? Hello everyone, welcome back to the SDA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high-quality tutorials, guides, and insights that mystify the world of trading. Join us as we will share more trading secrets and value insights. To stay updated and be the first to access these valuable resources, hit that subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. Let us understand Alibaba's core business model. Transformation defines Alibaba's remarkable journey. From humble beginnings as a B2B platform in 1999, the company has engineered China's largest e-commerce ecosystem, churning in revenues in excess of $33 billion in the latest quarter and aiming for 1 billion annual active users by the end of 2024. Strategic brilliance marks every step of Alibaba's expansion story. As Taobao's launch revolutionized Chinese consumer behavior, Tmall's introduction captured premium retail markets. Today's Alibaba stands as a testament to ecosystem mastery encompassing e-commerce, cutting-edge cloud computing infrastructure, Alipay's digital payment dominance, and Cainiao's sophisticated logistical network. These services that Alibaba Group offers aim to play a part in providing a one-stop solutions platform that cater to the needs of Chinese and international merchants and consumers alike. Has the company been successful in implementing its strategy of being a one-stop ecosystem? Let us now look at revenue streams and market positioning. Domestic e-commerce retail powers 40% of total revenue, while cloud computing, together with logistics services and international e-commerce, also contribute a significant portion of its income source. Strategic diversification elevates Alibaba beyond traditional e-commerce boundaries. 7 distinct segments generate annual revenues reaching $139 billion in fiscal year 2024, showcasing a business model that defies simple categorization. However, if we look closer at its latest second quarter 2024 fiscal year 2025 revenues, we note that revenues for Alibaba, largest contributor, Taobao and Tmall, declined 10% quarter-on-quarter. This is due to the fact that there has been increased competition of late, with Chinese and international e-commerce players alike such as JD.com and Shopee, who are also aggressive in their client acquisition tactics. Let us analyze some of Alibaba's current market valuation metrics. Numbers reveal truth. Alibaba's valuation metrics tell a compelling story of market irrationality, particularly when Alibaba Group's performance is dismal compared to the returns on the Hong Kong Hang Seng Index. Alibaba's share price is only up 10% year-to-date, while the Hang Seng Index is up 19% year-to-date. We first look at Alibaba's price-to-earnings ratio analysis. Alibaba commands a trailing price-to-earnings ratio of 17.79 times, while its forward PE sits at an even more compelling 9.55 times. Market disconnect becomes apparent when comparing these figures to the MSCI Emerging Markets Index forward PE of 15.25 times. The PE provides an indication that the current share price of Alibaba is fairly priced to date. The reason could be increased competition, driving down margins and thus making investors unwilling to invest in Alibaba due to its uncertain future in a competitive environment. However, balance sheet strength emerges through critical metrics as Alibaba's current book value per share is just $55 per share. Price to book ratio is 1.5 times. Its book value 5-year average growth is 13.7% per year. And debt to equity ratio is 19.3% for the second quarter 2024 earnings release. Alibaba is therefore trading close to its book value and has a low debt to equity ratio, indicating a healthy balance sheet with current market valuations close to its asset valuation. Investors seem to be focusing mainly on the company's growth prospects rather than the company's strong financial health. Therefore, it is important to decide if the market could be wrong in the long term and whether Alibaba could navigate itself out of this intense competition in the long run. Let us look at some of Alibaba's cash flow valuation metrics. Cash flows paint prosperity in precise strokes, and we look at its latest second quarter 2024 cash flow statement. Operating cash flow is $4.48 billion for the 3 months ended and $9.2 billion for the 6 months ended. Capital expenditures is negative $2.4 billion for the 3 months ended and negative $4.1 billion for the 6 months ended, while free cash flow is $1.9 billion for the 3 months ended and $4.4 billion for the 6 months ended. Alibaba Group has been generating healthy positive operating cash flows in both quarters and has a 6 months capital expenditure to revenue ratio of just 6%. This shows that the business does not require large-scale reinvestments and the business could turn into a long-term cash cow in the long run. The current free cash flow of $4.4 billion reflects this fact. Deeper analysis reinforces value conviction. We now study Alibaba's growth catalysts and future prospects. 3 powerful catalysts propel Alibaba's growth trajectory. Strategic initiatives unlock unprecedented opportunities, yet market sentiment fails to capture their transformative potential. Let's first look at Alibaba's cloud computing expansion. Alibaba's cloud stands as a testament to strategic execution. Revenue soared to $8 billion in the 6 months ended September 2024 earnings release, with cloud operations now commanding 11.3% of total sales. This milestone marks more than a diversification. It signals technological dominance. There is also international market penetration. Global ambitions materialize through strategic infrastructure deployment as data centers rise in key markets, such as the Mexican frontier, establishing the company's first cloud foothold in Mexico, and Southeast Asian expansion across Thailand and Philippines. We shall look at Alibaba's technology innovations pipeline. Innovation defines Alibaba's technological DNA. The Alibaba's QWEN model emergence reshapes competitive landscapes, while strategic partnerships with giants like NVIDIA accelerate autonomous mobility breakthroughs. AI integration reaches critical mass across Alibaba's ecosystem as Model Studio platform's latest subscription of 300,000 strong customer base validates its potential market leadership, suggesting exponential adoption curves ahead. These growth categories, combined with plummeting data storage and computing costs, position Alibaba as the nexus of multiple expanding markets. Let us now conclude and provide an intrinsic value for Alibaba. Market wisdom often hides in plain sight. Alibaba stands as a testament to this truth. Its sprawling digital empire spanning e-commerce, cloud computing, and financial technology, creating value that current market prices stubbornly refuse to acknowledge due to certain negative and uncertain perceptions among investors. Low double-digit forward PE ratio of 9.5 times, robust free cash flow generation, and fortress-like cash reserves paint an undeniable picture of financial strength. Regulatory clouds have parted, revealing clear skies ahead, while cloud computing dominance and international market penetration promise exponential growth factors. Emerging market exposure need not compromise fundamental strength. Alibaba's technological arsenal, from cutting-edge AI initiatives to strategic global expansion, forges a unique value proposition. Based on my discounted earnings model valuation, my estimated long-term growth rate for the company at 3% and an expected return of 8.5%. Using Alibaba's latest weighted average cost of capital, I value Alibaba Group at Hong Kong dollars $175 per share. At Alibaba Group's latest closing price of Hong Kong dollars 82.35 as at 27 December 2024, reflects a 53% discount from my intrinsic price. Therefore, its current share price indicates a good margin of safety to my intrinsic value. Should one hold the long-term view that Alibaba Group can eventually execute its strategies well and stand out against its competitors in the long run. Alibaba's trinity of growth momentum, fundamental strength, and compelling valuation metrics demands serious consideration from portfolios seeking both discovery and growth capture in today's dynamic market landscape. Therefore, hope you enjoyed my video and see you in my next video. Goodbye.